So this is a paper on taper tantrums, QE, its aftermath, and emerging market capital flows. And it's joint work with Carly Stedman, who's a graduate student of mine, and Christian Lundblad, who's a colleague at UNC. What I'd like to do is to start with this rather provocative quote from the president of Brazil, Dilma Rousseff, in 2012. If you sort of think about what this quote is saying, she said the crisis started in the developed world, and there are all these things the developed world is trying to do to recover from it. However, the quantitative easing policies have triggered what can only be called a monetary tsunami, and have led to currency war and introduced new and perverse forms of protectionism. So this term monetary tsunami has sort of really cottoned on with economists. And what we see is that there has been a contentious debate in the aftermath of the massive surge of capital flows to emerging markets in the following the GFC. So you had this initial retrenchment in the midst of the global financial crisis, but it was followed by a massive capital surge into emerging markets. And while the sort of the policy focus of developed market central bankers was to restore stability and growth in their domestic economies, it led to substantial spillovers into emerging markets. So as interest rates in developed economies remained low, what we see is that foreign investors from the developed world were attracted to a bunch of emerging markets, including India, Brazil, Chile, etc. So this sort of just gives you an idea of what happens is you have this retrenchment, which is followed by a massive surge. So the question is, what, if any, are the implications of unconventional monetary policy? And really what we'd like to do is to focus on what's in the parens, which is, and its potential unwinding for emerging market capital flows and asset prices. The other thing that I really want to focus on is the magnitude of these effects. So when we get into our methodology, you'll see that our focus is really on trying to quantify the magnitudes of this. And what we're going to do is that we are going to use a data set from the US Treasury that has thus far not been used to analyze this question of what is the impact of unconventional monetary policy on emerging market flows and prices. So what is the first thing that we need to do? We need to come up with a measure of a monetary shock. How are we going to quantify the monetary shock? And the second thing is, how are we going to link this to the capital flows data? So what we need is two things. We need a measure of relevant equity and bond flows, and we're going to focus on the United States because this is US Treasury data and their impact on financial prices. And the second thing that we're going to do is to look at this challenge of identifying monetary policy shocks, especially at the zero lower bound. And in order to do that, we're going to sort of take a finance lens. And there's this method originated by Kuttner in 2001, which is essentially to estimate the surprise component of Fed announcements. So the idea here is that if you have rational agents with rational expectations, things that are already priced into their expectations will not be important. What we need to focus on is the surprise or the shock component. And then what we're going to do is we're going to augment this methodology with this more recent paper by Koenig, Sack, and Swanson, where you want to not only think about policy, but you also want to think about path. So in the context of onward, sort of forward guidance that has been ongoing, we really want to think not just about policy, but also about the path. So what we're going to do is we're going to apply this setup to the new data and measures of UMP to analyze first whether the measured effects are larger during the crisis, whether they manifest primarily in flows or in prices. So here I'm talking about bond valuations or equity prices, and whether there are differential effects between equity and fixed income markets. And as I said already, the contribution of the paper is really going to lie in trying to quantify the magnitude of the spillover. So there's a lot of sort of hyperbole, provocative quotes from central bank governors around the emerging Asia and Latin America, but we really want to see what is the magnitude. And this is sort of somewhat preliminary, but we also want to be able to exploit the relevant country characteristics to shed light on the potential economic determinants of external policy shocks. So just a little bit of a refresher in terms of unconventional monetary policy and its mechanisms at the zero lower bound. What we see is that the ZLB period has involved heavier management of expectations and efforts to exert direct control further along the yield curve. So what we call forward guidance, if you are at the zero lower bound, you've sort of resorted to a lot of forward guidance to help sort of manage expectations or change expectations, etc. So if you just look at an N-year yield on a bond as the sum of two things, the first term is the sum of expected overnight rates. So this is the risk-neutral component of the yield, which can be affected by expectations. And the second is a term premium, which is essentially, the longer it's sort of capturing duration risk. And what this sort of, if you think about UMP in the context of just the yield curve, it implies new channels of transmission which have been explored extensively in the literature. So when we think about portfolio rebalancing, if you have sort of large-scale asset purchases or you're removing duration risk from the market, then to the extent that you have imperfect asset substitutability, you're going to have some sort of portfolio rebalancing. So some papers have focused on the portfolio rebalancing channel. Other papers have focused on this idea of expectations or signaling, and closely related to that is confidence. So there's sort of the confidence channel and the signaling channel really focus on this first term, the risk-neutral component, which is just the sum of the expected, so expected is important, overnight rates. And finally, of course, once you have yields falling, you have the liquidity channel, where if you have a lot of liquidity in international capital markets, that can affect capital flows. So like I said before, our main challenge is really to identify an exogenous monetary shock. And here, the issue is that what you want to see is the response of real and financial variables to this exogenous shock, which requires certain timing restrictions, which are basically going to guarantee that the monetary policy shock affects the dependent variables and not vice versa. So that's one challenge. The second challenge, I've already sort of alluded to this. In sort of new Keynesian monetary theory, what we see is that rational actors observe the state of the economy, they know the parameters of the central bank's loss function, anticipate future changes, and adjust their output and consumption decisions already. So what is it that matters in this context? It's only the unexpected elements of monetary policy should have an impact on real and financial variables. So the challenge really is, how do we extract this unexpected component of monetary policy? And that's what we're going to do. But before we do that, let's just look at what people have done thus far. The first is panel estimation with announcement or date dummies. Now here, the drawback of this is that, so you have announcement dates where the Fed changed interest rates, but what you may be missing is dates that contain a surprise insofar as the rate did not actually change. So that might be a surprise that you're missing in this data. The second is that if you just put in a dummy for an announcement date, you're not going to capture the magnitude of the surprise. So you don't know if this is a large surprise or a small surprise. Similarly, if you were just to look at changes in the Fed funds rate, that will also lead to an attenuated estimate of the effect of monetary policy to the extent that the rate doesn't change. The other approach that people have taken is sort of structural VARs, but that also requires additional assumptions, sort of timing restrictions, etc. So what we're going to do is to take this event study approach, which is slightly different from just having announcement dummies. What we're going to do is to focus on a variable that adjusts and is reported at a high frequency. So high frequency could be intradaily, but we're going to focus on a daily frequency. And what are data that are available at such high frequency? It's financial data. So we are going to employ high frequency identification to identify the surprises using an event study literature. Here, our approach is going to combine this high frequency identification of monetary shock with sort of panel regression techniques. Now, in terms of expectations, we know these are not directly observable. So how do we extract them? What we're going to do is to resort to futures data as a natural market-based proxy for expectations. Sort of changes in futures prices as a natural market-based proxy for expectations. Of course, this relies on this idea of rationality, which essentially means that if there's an unexpected event, so here we mean an exogenous monetary shock, it will immediately be reflected in prices. So a revision in the price of the Fed funds futures rate immediately following a Fed event can be attributed to unexpected policy change. So I'm going to put a little bit of structure on this. This is sort of this Kuttner methodology, which is that Fed funds futures have a payout that's based on the effective Fed funds rate that prevails over the calendar month specified in the contract. So let's sort of take a given FOMC meeting date and just the time before that, what is the Fed funds futures rate that's going to prevail? It's going to be a weighted average of two things. The Fed funds rate that has prevailed so far in the month, R0, and the rate that is expected to prevail for the remainder of the month. So here's an expectation term. And finally, you have some sort of a term or a risk premium term in this futures contract price. Now what we do is very simple algebra, just lead this one period forward, which is the date of the FOMC meeting, and then you difference the two, and the surprise component of the change is just given by the difference in the futures price on the two dates. So there's a certain rate that was prevailing before the meeting. If there's a different rate that's prevailing after the meeting, that difference captures the surprise component of the monetary shock. This scaling factor is just taking into account what day of the month does the FOMC meeting take place. So that's an adjustment we have to do. What you can do is you can also sort of look at a longer term measure of expectations by looking at the 2-month forward futures contract. And we do a similar exercise, and you do this difference between the rate prevailing on the day of the meeting versus the day before, and then you subtract off the expectations that were already captured in the 1-month forward futures contract surprise. So MP1 is the 1-month forward monetary policy surprise. MP2 is the 2-month forward monetary policy surprise. A final measure is simply the difference in the yield on the 2-year Treasury bond on the date of an FOMC meeting. So just the 2-year Treasury bond, what is the difference in the rate on the date versus the date before? Now the correlation of these surprise measures, we have these 3 measures, 1-month forward, 2-month forward futures, and then this change in the Treasury, 2-year Treasury rate. These are sort of the correlations between these expectations measures. So what this does is that these 3 measures provide information about the expectations shock into the future. So you have 1 month, 2 months, and you have 2 years. So you're going down the yield curve. And just to give you an idea of what we extracted, and this is not just FOMC meeting dates, we also have if there was a speech made by the governor or there was congressional testimony that was given. For example, the quantitative easing, the first time it was mentioned, it was in congressional testimony. Similarly, when it comes to the taper talk, the first time it was mentioned, it was in congressional testimony. It's only the second time that there was actually an announcement. So if you look at our first monetary policy surprise measure, you see that you get quite a lot of variation. It's actually measured, and the surprises get smaller over time. If you look at MP2, you see that the surprise is bigger as you go through time, and the reason for that is there's greater uncertainty in the future. So if you go into the 2-year window, you see that you get even more changes in expectations given the uncertainty longer into the future. So what we're going to do is to use this monetary policy shock measures and combine them with this US Treasury data from the Treasury International Capital System. And what this is it pretty much includes everything. It has transactions by US custodian banks, pension funds, endowments, foundations, direct issuance of securities by US investors or firms. It covers the whole gamut, broker-dealers, and so what this is data on US transactions with foreigners in the short and long-term domestic and foreign securities by type and country on a monthly basis. And what we have in the data is net flows, net equity and debt flows, which are gross sales to US residents by foreigners less gross purchases from US residents by foreigners. So it's a net flow measure. And what this does is allows us to track portfolio reallocation. And it also provides us with a high frequency time series that can be decomposed into flows and estimated value changes. So I'm not going to have a lot of time to talk about this, but essentially what you have is you have the holdings at time t of security I, let's say, and you can have a subscript J, it's to country, it's to India or Brazil, and that's going to be a feature of the holdings in the previous period multiplied by a change in the valuation, plus the new flows, plus this term AIT, which is just the repayment of principal on asset-backed securities or stock swaps from M&A. And this valuation basically depends on how much of the position is held in a local currency bond versus a foreign currency bond. So there's a currency adjustment of the currency composition of US resident positions. Now there's an issue that when you think about it logically, if you sum up the flows, you should be able to get the holdings data. But of course, we don't live in a perfect world and we don't see that. And so the accumulation implied holdings over time don't really match there's a gap with the reported holdings in that month. I'm not going to get into this, but basically there's a financial center problem. If transactions are routed through a financial center, they're going to be underestimated, etc. So Bertoux and Judson from the Fed have developed this methodology to attribute this gap, and we just incorporate that as well into the measure for the holdings. So it's essentially valuation changes, flows, and this residual gap. So the countries in our data set are these big emerging markets, the big Latin markets, the big Asian markets, and we have Russia, South Africa, and Turkey. And you can't really see this, but what you see, one thing I do want you to see in this slide is that total positions, if you look at pre-crisis, they definitely surge in the QE period, but they continue to go up during the taper talk period as well. And you see that in bond positions and equity positions as well. But one thing interesting to note is that during the taper talk period, bond valuation changes are negative. So something is happening with emerging market bond valuations during the taper talk period. And consistent with the capital flows literature, we have to incorporate push and pull variables into our panel estimation, which essentially we break it down into 3 sub-periods: the pre-crisis period, the QE period, and the taper period. And what you see in the pre-crisis, we wanted to see if the results were different using these monetary shock measures across the 3 periods. What we see is that bond flows are directly and significantly related to the surprise measures, which essentially means a tightening in the US leads to larger flows to emerging markets in the pre-crisis period. Similarly, US tightening surprises are correlated with a statistically significant decline in emerging market bond valuations. When we look at so the only thing in the pre-crisis period that shows up as having a significant effect is bond flows and bond valuations. For all the other measures that we have, the monetary surprises do not appear to be significantly correlated with the US capital flows. We have a measure of global liquidity, which is not surprisingly inversely correlated with capital flows. The S&P 500 is directly correlated, so again, 2 push factors. The emerging market policy rate and the MSCI return, the emerging market return, have varying impacts on both holdings and flows, depending on the sub-period under consideration. So what we see here is that if you look at this third line, the only 2 sort of significant parts are this bond flows and bond valuations during the pre-crisis period. For the MP1 measure, what we see is a similar pattern during quantitative easing. But if you look at the MP2 and the 2-year bond yields, you see that the shocks start to become significant across a lot more of the measures. So what are the measures? We have total positions, total flows. We have bond positions, bond flows, bond valuation, equity positions, equity flows, equity valuation. So we have a whole series of sort of flow and position measures that we can use to look at the impact of incorporating this monetary policy shock measure along with the VIX and the other pull and push factors. The one thing that I want to point out is that the taper talk period reveals yet another significant shift, which is that the coefficient becomes inversely correlated consistently, sort of 9 out of 10 of those measures, it becomes significant and inversely correlated, and it is an order of magnitude higher than that during the QE period. So just a very quick, I just want 1 minute to go over this because this is really the magnitudes that we see. So the QE coefficient on bond holdings, for example, is this negative 6931, and on equity holdings is negative 33.541. The mean sort of shock during the QE period is this number. And if you simply multiply the mean shock by the QE coefficient for bond holdings or the mean shock by the QE coefficient for equity holdings, what we see is that in the QE period, the average monetary policy shock, which is a loosening shock of about half a basis point, appears to have caused, on average, a 33.74 million increase in emerging market bond holdings and a 161 million increase in equity holdings. During the taper talk period, we see that these coefficients are an order of magnitude higher. And what this tells us is that a mean magnitude tightening shock, this is positive, it's a tightening shock, led to a 334 million decrease in bond holdings on average and an 834 million decrease in equity holdings. And similarly, it also has an effect on flows. So this is what I mean by being able to use this monetary policy shock magnitudes to quantify the effects of unconventional monetary policy. And as I mentioned, this is very preliminary work. So what we're planning to do is to explore the magnitudes of these policy surprises on a variety of holdings and flow measures. We can examine the entire distribution of monetary surprises. That is, what is the impact of a 1 standard deviation from the mean monetary shock on holdings and flows. We can sort of quantify cumulative if the cumulative effect of monetary shocks during the QE period or the taper talk period on emerging market holdings and flows, country-specific characteristics. The main sort of takeaway from this is the advantage of extracting the magnitude of monetary surprises directly from the futures data is that we can conduct such exercises to estimate a dollar amount in terms of US investor position and flow changes to emerging markets, controlling for these push and pull factors. And I'll just close by saying, given the imminent rate increases that are anticipated by the Fed in the coming months, this exercise potentially has significant policy relevance, especially for emerging market central bankers. Thank you.
So they are based on my quick reading of the paper. And this is the first version, so I'm sure that the final one will deal with all the comments, and maybe some of my comments are related to my misreading of the paper. So let me start with the definition of the data. When I read the abstract of the data in the middle of the paper, what impressed me is that the focus is, if I read correctly, that it deals with bonds that are long maturity and securities. And at least in this statement, it seemed to be that you are not measuring, this data is not measuring hot money or short-term bonds. So please correct this. So this is one of the hazards of reading it, the first version. So this comment definitely is irrelevant, but then be sure to specify more carefully because this is cut and paste from your paper. Now, the focus in the panel is on the countries that are stated here. So let me skip the question because you answered already the question, so let me turn to the second. Now, in the concluding remarks, you're making the argument that I fully agree, that it's nice to focus on the surprise in the announcement relative to the benchmark, where the benchmark may be retrieved by, say, whatever that we see in the patterns of the yield curve and the like. So I agree that this is a great advantage. Now, let me turn to some limitations in the way that I see this. You're saying the goal going forward is to do in-depth analysis of the implications of all the changes, including the coming changes in the interest rate, on the global economy. And your focus seemed to be more on the emerging markets, ignoring thereby the possibility that some of the action may happen in the context of a third or a second party with indirect transmission. So let me give an illustration of this. So if you are focusing on this analysis, going back to the onset of the global financial crisis, the big surprise initially was the buildup of a huge dollar gap that appeared not at the level of emerging markets, but at the level of the Eurozone mostly. And here I'm citing a paper that goes back to BIS 2009. And the main point is that all your calculation is ignoring any buildup of dollar funding gaps that may appear, say, in a third party. In this example, in the crisis, it was Europe. It was huge. And a lot of the dynamics in the first phase of the crisis were generated by this buildup. So my recommendation is, once that you have this data, I suggest to look at all the countries, including all the financial centers, because most of the transmission, or a lot of this, may be through financial centers. And we know that in the context of the first trigger that induced the swap lines of the Fed, it was not related to emerging markets. It was more related to, if I recall, Switzerland, exposure of financial centers or quasi-centers, including Switzerland, the UK, and the like. Now, we don't know what will be the shape of the next crisis, so definitely this may be useful. Now, conveniently, in the flight, I was exposed to Financial Times report of the 9th, and I was amused because while reading your paper, I thought that, gee. So this is the report coming from the Bank of England as we are speaking, -2 days. So UK banks' exposure to emerging markets could prove critical if the US raises interest rates. And you can read the entire statement here. So this is only one example that maybe second party, especially this party, is the City of London, and the Bank of England is focusing on them. They are very concerned that if the Fed will increase the interest rate in a way that goes beyond the expectations, so then they will be exposed to, and they are stating that the tier one there is falling short of the need to buffer. So the bottom line, I definitely think that I don't see a reason why you should focus only on emerging markets. At least you should add to this Hong Kong and all the financial centers, because some of the transition and transmission may be generated by these second and third parties. There is a reason to believe that a lot of the decisions of the Fed, despite the dual mandate that's supposed to focus entirely on the US, may be sensitive to factors like whatever that happens or not in China, the price of commodities, which are related to China and to the global business cycle. So I suggest to control fully for the entire vector of variables that chances are that are impacting the decisions of the Fed. Because ultimately, it will be not the decision of the Fed, but maybe the endogenous factor that is shaping the decision. And this is public information by now. So down in your regressions, I suggest to control for these factors, because the biggest uncertainty is less when and what will be the first increase in the interest rate of the US, but what will be the coming trajectory of increasing, or the slope of the future increases and the shape. Now, chances are that this will be dictated not only by whatever that happened in the US, it will be dictated by the global picture, where all the second and third parties will play a role, including China and the like. So I suggest to try to control for all these factors, and I'm looking forward to read the final version. Thank you.